intervention. For more market insights, Ryan Lamond, CEO and co-founder at Neovision Wealth Management, joins us from Abu Dhabi. Ryan, always good to chat to you. I believe it's the first time we've spoken this year, so Happy New Year to you. There's a lot to unpack here, but maybe let's just start with the fact that there's been a lot of geopolitical headlines at the start of this year. Once again, tariffs coming in focus this morning, but it really feels as though markets have the ability to look past a lot of those headlines and really focus on key drivers, including monetary policy and earnings. Why do you think that is the case?
Good morning, Romana. Great to be back. Thank you for having me. Well, markets have become a bit resilient because they've gone through Trump 1.0 and now Trump 2.0. Obviously, Trump 2.0 dwarfs Trump 1.0 with everything that is happening, the announcements, Greenland, tariffs, etc. But as you said, when we used to open our Bloomberg terminals, Trump 1.0, the first thing we used to look at are Trump's tweets. Today, we do the same thing, but today we take it a bit less seriously because, as you rightly mentioned, less than 20% of the things he announced actually goes into effect. However, we remain extremely cautious and nervous because we're really afraid that something goes into effect that could seriously hinder markets or international geopolitics. The weaponization of trade, banking, finance, and the US dollar have had a detrimental effect on the US. And we're always afraid of an action that could be, again, detrimental.
Yeah, Ryan, in our conversations last year, you were a bit skeptical about the extent of the AI rally. And you, again, look at the playbook this year. And even David Solomon was just speaking to our colleague there, talking about a possible broadening out of the rally. And yet you look at the biggest drivers of the S&P this year, it's still the tech names. And actually, this year, what you're seeing is memory chips as well are having a great run, a great start to the year. Do you expect that to change?
Well, Romana, in our conversations, early 25, mid 2025, I've been negative on two things: US dollar and US stocks. S&P 500 in 2025 has gone up by 18-19%, while the US dollar has dropped by 9%. The US S&P 500 has been one of the worst performers among developed markets. If you look at Nvidia and a few tech stocks, they've been relatively going sideways the past 6 months. So it's unimpressive. Now, what is positive is the Russell 2000. So the rally in the Russell 2000, in our opinion, signals a broadening of that rally, and it's something more positive because we as institutional investors were not very concentrated in our portfolios. We diversify, and we cannot just focus on tech. We have to focus on everything else, and that's why we've been negative on US stocks. Today, with the broadening, with the Russell 2000 starting to move a bit, this is quite positive for US stocks, so we're cautiously observing it. As for tech, well, Nvidia is 186, going sideways.
Yeah. Okay, clear on that point. One other question for you. We're eagerly anticipating the announcement of who the next Fed chair is going to be. Rick Rieder has massively moved up in betting odds over the last couple of days. And he was not the front runner a couple of months ago. Do you think that will be well received by the market? And if so, why?
It's very hard to say. We were sure about previous candidates, and now we're not sure anymore. So I prefer to be very cautious there. What I'm sure about is that President Trump will select the candidate that will implement the monetary policy that he wishes to support his administration plans, strategic plans. And this is a very relaxed monetary policy, reducing interest rates, etc. And that's obviously very positive for markets. Will it be positive for the macroeconomic backdrop of the US? I'm not so sure. So again, regardless of the name, what I think President Trump will choose is relaxed monetary policy.
Okay, Ryan, to round things up, I also want to ask you about the big story of the week. That is the price action in dollar-yen and the fact that there is really high anticipation that some form of job owning or intervention is going to take place. How do you see the outlook there? We've seen a massive repricing of Japanese assets, be it in JGBs and in currency space over the last couple of weeks. Are these intervention attempts going to be successful?
So this is one of the rarest times where we see that the Japanese yen pricing Japan rather than pricing US dollar. So today the Japanese yen, I think, is reflective of what's happening within Japan, where the Bank of Japan is very reluctant to intervene because all of the assets that are held by the Japanese Bank of Japan and by Japanese investors abroad, and particularly in the US. And second, you have the carry trade. So if the Bank of Japan actually raises rates because inflation is going up, and rightfully so, they have to intervene, this will affect all of these capital exporting activities of Japan. And that is why today, I think holders of the Japanese bonds are quite cautious, are afraid that actually the Bank of Japan will not intervene, and this is why they're selling it. So we've seen a Bloomberg news story about the US buying Japanese yen a la 1985, and I think this could be quite dangerous for all of these capital flows happening between Japan and the United States.
Ryan, always good to chat to you. Thank you so much for joining us today. Ryan Lamont, CEO and co-founder at New Vision Wealth Management. Okay, we're getting some earnings coming through from